we've got a real mix of expertise on the panel here. So maybe if we just start off with just a quick 1 minute, 30 seconds, who you are and what your company focuses on. Neil, you've reached for the mic. Why don't we start with you?
Thanks very much. Good morning, everyone. Thanks for having us and making it today. So for our firm, Alvarium, we started about 10 years ago out of London with the philosophy of our founders that we would invest our own capital into real estate, and rather than do it blindly, we would work with local partners, own a stake in their business, and then essentially buy their track record to then be able to put our own capital in as an LP within them. So we started off with London residential, then asset-rich operational companies like hotels, and now we have a platform of 11 different strategies from retail to, there's a REIT in there, there's structured debt in there as well. So it's all across the capital stack, all across asset classes, and now we're very much growing in Asia, with our chairman recently moving out this way. And so we've just done a $500 million deal in New Zealand, started in Australia, and continue maybe even to Southeast Asia. But historically more around Europe and the UK, and which is more topical for the discussion.
Fantastic. Eugene.
Morning, guys. Thanks for turning up. I'm from Rosebery Capital. I founded the company about 5 years ago. I myself was 20 years in finance and then finally got fed up with it and left the bank and started a platform which built a portfolio of, started off by investing my own money and then gradually managing family offices' money, and built a portfolio of mainly student assets and hospitality assets in the UK. Developed, bought the sites, developed them, and now we manage a portfolio of about 200 beds. We're looking to grow the portfolio mainly in London and peripheral London, and it's been a good journey. Pre-Brexit, post-Brexit, lost money on the FX, made money on the property, so we'll just balance this out.
Fantastic. And Frank, microphone there. Switch.
Hi everyone, this is Frank. Eurotower Capital, we are based in prime central London. Office in Baker Street, we look around only in a very small area. We were starting investing in London since 2013. Deliver quite a few products, not much after the announcement of Brexit. Then we have switched the investment to Greece. So far we have delivered 500 units, resorts, residential, Athens, off-islands. So this is pretty much it is for our investment in Europe. Personally, I'm from a construction background as a family business, so we're still, looking at the deals in London, but also we are looking also to Hong Kong recent years.
Fantastic, great intros there. So Brexit, that's the hot topic of the moment. What has it done in terms of its impact on investor appetite for the UK as a property investment destination?
No, I mean, Brexit has done a lot of things, obviously. It's made a lot of changes. But I think what is often not discussed is what hasn't changed, or the fundamentals of the market. Because, I mean, all three of us have been through the pre-Brexit and the post-Brexit. I mean, overall, I've made money. So I still think, reasons why I'm investing in schemes now is more or less broadly the same as the reasons that I've invested in these schemes 5 years ago. So I think Brexit has definitely had an impact, but it's important to think about other factors that are at play and consider the overall effect. But obviously, what has changed is very noticeable in terms of the value of the pound, I'm no currency expert to say where it's going to end up. But as a platform, managing family offices' money, I definitely see the level of interest being multiple times of that before, thinking that this is the entry point. What has also changed is, as a result of the pound, there are a lot more visitors coming to the UK, whether these are tourists or whether these are students or whether these are, even corporate travelers. And we are positioned to specifically, capitalize on Chinese demand. So, you see a lot more Chinese students. I mean, 100,000 students in the UK right now. You've had 10,000 Chinese companies 7 years ago in the UK, and now you've got 30,000 companies, and you've got more than 20% growth in tourists. So we try to focus on capitalizing that, and the student schemes that we have, there are like 60% Chinese students in them currently staying in them, and I might not be sounding politically correct, but the Chinese are the best tenants you can ever get, because other students they throw parties in your dorm, but the Chinese students they go back to their room, play with their phones, and that's it for the evening. So the best tenants in terms of maintenance. I mean, I love them. So to say the least. I mean, you find dead bodies around your student accommodation dorms, and so I think fundamentally, UK is still in a shortage of housing type crisis. London remains the most least affordable cities. That's why we invest in them, and I think aside from that, liquidity is abundant. I mean, lending or the availability of financing is at probably the same levels as pre-crisis now, which may not be a good thing. It says that the system is probably quite leveraged, but there's a lot of liquidity, and there are a lot of transactions from all over the world, which means that you may not make the most money, but at least you have a clear exit strategy. And so I think just in terms of that, you've got a lot of European, especially at the institutional level, where London remains the highest interest rate, or the highest yielding market in Europe, because interest rates in Europe are just negative. So there is a lot of liquidity, which is important for the sectors that I work in, which are not necessarily formally recognized as an institutional product, but a lot of institutions are now going into these sectors. So I think if you look at where the Brexit has done, I've benefited from an event like this, and I think these fundamentals will carry on in the future. And if you look at London or the UK being a post-Brexit, probably no corporates moving away, or a relocation of staff. That brings for us that brings an opportunity to the short-let market, because you may have been posted in the UK or been based in the UK on a permanent basis, but as a result of Brexit, you may have to be relocated to Frankfurt or whatever they think the next financial center is. But they will probably still spend 3 months in London every year, and that creates an opportunity for the short-let or what we think the service department business.
A lot of information there you got through. Neil, what do you think of his assessment?
I think it's great that you said you've seen the opportunity of Brexit. I would probably say it would have been better if it didn't happen. Not saying about the vote, but at least in terms of how this has dragged on and the impact it's had. I think when we first saw Brexit announced, there was huge capital flowing, particularly from Hong Kong, to buy office buildings. That continued, but then within the last couple of months, everyone got really quite spooked. I think everyone's like, oh, London's London. 5-10 years, absolutely fine, we'll still keep investing. But then as everything deteriorated and the way that things were handled, people lost confidence in that whole legal system that exists there. So I think it's been pretty damaging, and you've seen trade volumes drop quite a significant amount in the last couple of months. And I think it's wise as an investor in some respects. Why invest right now when you can just wait a couple of months' time, and if you know which way it's going, you may lose 5 or 10% on your investment, but hey, at least I have certainty and I know where it's going. But then you have the other side of the camp that goes, well, actually, the pound is low now, that's almost instantaneous, the opportunity is now, there's blood on the streets, so let's go out and invest. So there's a huge, talking to different co-investors and internally with our own shareholders that invest, there's very much different schools of thought, but overall, this uncertainty from Brexit certainly hasn't been great, and I think the economy and everything would be doing a lot better without it. I won't talk too long, but I'd say in the last 12 months, we've invested into 4 hotels. We're doing a residential development project. This week we agreed on IC. We also did an affordable housing strategy in Ireland. So we've been very much active, but where we're active is so much more defensive than ever before. Hotels, pound drops, people will still come. It's cheaper for them. So there's a good flip side there. Residential, you mentioned structural imbalances and inaffordability. Ireland in affordable housing, the government just can't. It's a bit of a play on policy there. But in general, the way we look at the deals is so much more defensive rather than looking at huge equity upsides further down the line. So whether it's doing your traditional Hong Kong investors doing an office value add project, I think they're seeing that as not being very lucrative in the financials. And maybe, Frank, that's a good segue for you and how you've been looking at London.
But before we get to Frank, the prices that you've paid for these deals that you've just done, how did they compare with what you might expect to pay in a more normal market?
I think it's the type of deals that we're going for, their market, essentially, of what market is today. So prices have generally stayed flat in these segments. We're looking at doing significant value add. So, for example, the residential planning play we're buying a site, and we're creating value by turning the leasehold into a freehold. We also got in touch with the freehold owner. And then we will be going through the laborious process of talking to the council to get it and then exit. And the exit price on that is roughly a £700 per square foot type of residential unit. If you're talking about Zone 1 London going from £1,000 up to £2,000-3,000 a square foot, it's much more in that affordable segment that's addressing this chronic shortage of housing. So I wouldn't say, look, we're picking up deals at crazy record discount pricing or anything. That hasn't happened in the market. If anything, it's just volumes have really come down. I'm sure you can always pick and find dislocations, but generally it's where do we want to deploy the capital? Where can we add value? Where's the buffer in that as well? So that, for example, we have a 15% buffer on the pricing. Even if it drops from there, we'll still make our money on that. So that's kind of how we look at the deal overall.
But you do read quotes. There was a quote from Coutts I read recently where they said that prime real estate in central London, you're seeing discounts as high as sort of 40% maybe on prices in sort of from 2014 to now. So there are good deals out there for the dollar-denominated buyer.
Yeah. So we're playing in the affordable side. If you're looking at the very top-end luxury, where it really has been hammered by the higher stamp duties, talking about capital gains taxes coming in and that uncertainty around there. So that is where there are discounts and people are buying bulk residential, for example, 20 or so units and going in there. But you're still in somewhat the luxury sector where you're planning on, the luxury or the high-end segment does very well when the market's good, and it does generally poorer when the market's not doing so well like now. So you're kind of hoping that it will bounce and come back. If you're speculative, sure, go for it. Like that's more of a play that you want to do it. Do I want to be a developer going in, buying a piece of land and building the best residential place in Mayfair? For us, we just see that as so much risk because to get your 20% IRR, you're underwriting an exit price so high that it just doesn't sit very comfortably right now with where we are in the cycle, 10 years constantly going up with the residential cycle, equity markets. Yeah, it's how different investors will see it differently, but that's our view.
Let's go back to Eugene.
Well, I agree. I don't see a lot of stress. I wouldn't say there's a lot of stress in the market, but what I will say is that we do see deals in prime London the likes of Mayfair, where leveraged has hurt a lot of small to medium-sized plots, and you see some degree of forced selling where you will see a correction in pricing.
I agree with you both. Let me tell you from my personal experience, because we were doing this buy and sell strategy back in the years when the international investors, they are pouring in the money to prime central London. We do it pretty good, but now we have still some stocks on hand. We're looking to sell instead of buying more, because if I would like to sell, I would like to sell it at a decent price. Would not like to sell it at a discount. It's the same way that we are looking at new deals. There's no exits of very good deals on the market that we can see 20 plus IRR that Neil has mentioned before. So I believe now is the time to be more cautious to do the buy and hold strategy when the opportunity comes. I'll say let's be more cautious, and that's why we have also switched our strategy to Europe as well, which has we see more opportunity to grow.
Have we seen the uncertainty around Brexit impact councils and their planning permissions? You do read about planning for new developments being delayed. Is that impacting the supply chain?
Planning it impacts the social fabric of that place, or that micro location. So when we do residential planning plays, which we've done over 20 in London and pretty much a bread and butter of our business, each council, each individual, it's such a local game that you need to understand the dynamics there. There are always overarching targets. So, for example, in where we are doing it in Colliers Wood, it's like in that area, they're targeting 6,000 units in the next 5 years. In that micro location, it's 500 units over the next 6 years. So that the council have this need and demand, and there is this macroeconomic issue where there's a shortage of housing. So it's there. It's just how do you kind of lobby? How do you talk within that local group of individuals? And so it's very much a people relationship game as well. So it's a little bit difficult to quantify. And I found in Hong Kong, this isn't a strategy that's in Hong Kong, because you have to pay a premium if you convert from an industrial building to a residential building, and that takes away all your profits. That premium doesn't exist in London and most of Europe actually as well. So you can make your 2x return in a very short amount of time, let's call it 3-4 years even, but you need to have trust that you'll be able to get it. And people still have this fear that it's a binary outcome of a yes or a no, but generally it's more of a yes, but you won't get the density that you're after. So you need to know the planning rules and the local market. So we've got planning on about 3 or 4 different sites in the last 12 months. So, and we've never not got a planning in our process. So we feel that if you know your market and your target and who you're talking to, it's okay. You can get it.
And we have an election coming up in a few weeks' time. What do you think, what result are you looking for? What would be a good result for the market? What would be a bad result for the market?
I won't take that.
I'll pass that on. Well, but what I would say is that I think since 6 months ago, where we've had a deal from Theresa May, I personally think that is probably probably the worst deal that could have happened anyway. So anything that happens from here is it should be just pure upside. I mean, for us, I've got no idea where this is going, but I just think that there can't be any more downward sloping.
But Corbyn or Johnson? What a choice.
I mean, Trump got in, everything that's going on in the world, I feel like I can't guess anymore. I just hope for a smooth Brexit, that's all I can say. And there will be a deal.
Okay, well let's talk about in London. Okay, we've talked a lot about London, but what are the hottest opportunities you're seeing in the capital at the moment in terms of sectors? We had a little bit about co-living. What other sectors are you seeing opportunities in at the moment?
No, I mean where we operate, which is prime London and peripheral London, the sectors that we have always been operating in, which are students and hospitality, we see a long-term value in these sectors as a result of Brexit or whatnot, for the reasons that I've just mentioned. I think where the traditional long-let market is being hurt, there is a turnaround opportunity in converting assets into a short-let positioning where the population is becoming more transient. In terms of students, it's a double-edged sword, if you like. I mean, if the currency goes down, you get more students. If the currency goes up, your value of investment goes up. That's my experience.
I would still go for prime central London. Given there's pursuits, maybe less jobs will be created in London. But for prime central London, the supply is all-time low, and there's no new supply at all. I mean, over the many years that we have seen on the market. Even the crisis comes in, like in 2008 and even before, prime central London is always going up. And education and the UK core value is still given there, given the backdrop of Brexit. So I don't see any back risk for valuation in prime central London. It will be a short time price drop, but in the long run, I mean, if we look into the next 10 years, 20 years, I do believe in central London.
I think, Frank, that definitely reflects a lot of the family mentality that I've seen investing into London, where buy an office building, get a 4-5% yield, hold it, and the value generally will also go up in that time. And hey, 4-5% is not terrible. And I think Zone 1 London is such a liquid market that there'll always be a trading market there. And the fact that it is yielding means that any fallout means that, hey, your leases won't expire for maybe 5 years. So you'll still get that income recurring over any kind of downturn. So it's important to look at where your leases are expiring if you're going for that strategy. Going into London, it's about how you analyze what kind of return you're looking for. Are you a yielding playing investor? Then sure, I would go for London and office at the moment. A couple of years ago, the northern powerhouse cities were all doing very well, the regional cities in London, and everyone's going there to get 7-8% type of yields. But now that London's sort of softened a bit, getting an additional 2% type of yield, I think has probably deterred some investors from maybe going out there. They think, what's the point? I want security in being in Zone 1 London, so I'll stick to that location. But if you're a 5-10 year horizon investor, absolutely, that's how I would look at it. The other side is if you're more of a return equity type of investor, you do have to step outside of Zone 1 London to really generate a 2x sort of return in a 3 to 5 year period, which is more where we play. And that's why we'll look at residential, we'll look at hotels. Again, it's defensive. Pound goes down, people go and stay there. Tourism increases. Nobody likes retail at the moment, but it's still one to watch. We're not putting a bet in to go in just yet, but there's a conversion where the yields of retail are almost coming down to industrial. So that makes you think, that is seriously hitting in a point of serious undervaluation. And then finally, it's really the debt space. If you can't make these returns going in as equity into these deals, why not go and play as senior, stretch senior, or even mezzanine, where you have second or first, ideally first charge or second charge on these properties. Your effectively LTV means that you're buying at a 60 or so % discount or 70% discount. And you still get a nice coupon, which is probably more than your 5% yield. It's slightly higher. But then the mindset of those investors are slightly different to just a family that want to hold an office building in prime central London, but as a more as another investment class, that's where we also like to play in, and we're doing more in the debt space there as well.
Do we have anyone in the audience who has any property in London or is invested in London? Any thoughts on what Brexit is doing for your appetite for the capital?
Okay, we've just been converting, accumulating sterling in the past 6 months. So as long as we see anything good, I think we've got enough cash to buy at the dip.
And now looking forward to a good election result and a good Brexit deal to bring that sterling shooting back up again, yeah?
Well, I've kind of lost hope in that aspect, but...
Is it office or residential that you've hold assets in?
We do commercial and residential.
Right. And in terms of location, is it core zone 1 or are you on the fringes?
Prefer zone 1,
right.
Central London, but we also look at outside because there's higher yield, as you said, yeah.
I mean, from my experience, then what I understand is still the leasing market is holding up quite strong.
Yes.
So when you say it's hard to find a tenant, or that's your worry.
Well,
I actually
don't think
found
it's
the
going
opposite.
to be hard. It's just the price.
Right.
Yeah, it's like how much you can achieve later on.
Right.
Let's look, beyond the capital, and some opportunities in other cities. In the other cities, you mentioned the Northern Powerhouse, and there's places like Birmingham. You've got getting a high-speed rail going in there. You've got the Commonwealth Games coming in 2023. They've just announced a 1.5 billion regeneration of the Smithfields complex. I mean, where are the good opportunities outside the capital in the UK at the moment?
We've been staying in London and peripheral London for a long time. We've never been able to reach out to. I remember when we were first investing in schemes in 2015 in London. The family offices used to tell us that just go and buy the highest yield. I mean, I come back with a London asset that yields 5%. They are puking at the idea, and instead they prefer somewhere which is yielding at 8-9%. But what I do want to say is that a lot of families treat this as a fixed income, almost like buying a bond, except where real estate doesn't have that capital protection at maturity. So if where you will be receiving $100 back at your maturity when you have a bond and you yield an 8%, that's great. But if you buy a real estate at 8% and you lose money on the capital value by another 8%, then you're just on par. And I think that's an aspect where a lot of families don't think like that, and they just simply look at, or they place a lot of emphasis on the yielding side of the asset. What I think there needs to be a greater. There has been a greater emphasis on capital appreciation. If you look at student assets in London, the planning side of things, as you've just mentioned, is non-existent because you would never get a new planning scheme on a student asset in London anymore because of just competing uses in resi and all that. And it has benefited from a lot of yield compression.
So, as someone who develops student accommodation, why are you not looking in places like Manchester, Liverpool, Leeds, Oxford, Cambridge, maybe? There are many very big universities around the UK.
Yeah, I think you have to. Given the supply in London and a lot of students and a lot of universities in the regions, that there is no choice if you were to actually build scale. But I think what has become very important is, and people talk about micro locations, and there has, it's a very difficult strategy to in terms of execution, because if you're 10 minutes away from a uni versus if you're 20 minutes away from a uni, you would probably get a yield premium as high as 50 bips. So it's not been an easy strategy to execute, and the asset itself is a lot more important now than maybe 5 years ago.
Do you have any concerns of post-Brexit, stricter immigration controls limiting overseas students coming to the UK?
I think I am, but if on a relative basis, you would see the same problems in other student markets. If you look at just where the pound is, the cost of a higher education degree is probably 30% cheaper than the US. So if a Chinese parent chooses between these two markets, it's $30 cheaper.
Neil, you mentioned that you've branched out into Ireland now. What's driven you to what makes Ireland so attractive for you guys?
So I think overall Ireland as a Brexit benefiter, if people talk about maybe office tenants moving out, Ireland being very favorable, they've got great tax treaties, they've got Facebook, a lot of the tech guys are there. So naturally people thought, oh, everyone will move to Germany, but a lot of Londoners don't speak English and would rather live in Ireland. It's culturally a lot more similar. So from that aspect, top down, I think it does have that attraction. It's just a great place to live. I'm half Irish, so I'm biased. And then in terms of the actual real estate play that we've gone in there, we saw a actual advantage from the government side. So they have a structural issue whereby housing has just crept up and become so unaffordable that the government has tried to build their own schemes, and even to the extent where they don't even go through a planning permission process and they just get a piece of land and say, hey, we're going to build affordable housing, and then the local residents going, actually, you can't, and then it's got very, very political. So what they've done is they've turned to the private market and said, if you can build us a affordable housing to specification, we will sign a 25-year lease with you that's indexed to inflation, i.e. build a bond out of real estate. So we got together, we have a local team that is going out there acquiring sites. They will then fix them up and then turn around and lease them to the government. So it's almost more like a policy play that we are going into Ireland, which makes sense from the bottom up, but then from the top down, you have this whole kind of general, more Brexit positive story that's coming out of the whole saga. So yeah, we'll continue to look. Yields are still very high in Dublin, in particular for residential and office. So that's quite attractive. PRS though has been squeezed to under 4%. I think one transaction I saw, which was extremely tight. There's just not enough residential housing, and Facebook are probably having to build now their sites to be able to accommodate their staff. So it has great fundamentals as a city. But the problem is, again, access, and how do you get access to these deals? And we're all sat in Hong Kong, and you can have this top-down approach, whether it's regional cities in UK or it's Ireland. It's important to have your view on where's great, follow infrastructure, follow where there's structural issues, but how do you get access to these deals? And our way to do that is find a local partner and basically bet on them to be able to have the local connections to find those sites for you.
Aside from the PRS sector, what sort of yields are you getting in Dublin?
Well, we are buying our residential stock at roughly 8% yield. So these are fringe residential properties. So affordable housing, as you can imagine, is not in the best locations, but they're still within 20 minutes drive of Dublin CBD. So therefore the yields are much higher. But you can imagine the value, once you transfer that lease where, earlier we were talking about the value of the lease, a lease for a tenant in the outskirts of Dublin, they're paying 8%, but once you get in a 25-year lease indexed with inflation to essentially the government, that valuation comes straight down to 5.5%, 5%. So that's how we've instantly created value on day one with these acquisitions that we're going in at.
Fantastic. Frank, you mentioned earlier that you're looking at Greece. What are you doing over there, and why Greece?
Greece is a very interesting market. There are not many institutional investors that I've been aware. We, as a family office, we get there quite early. 2013, that was, a market that was pretty, a bottom-up market. But then, the bottom-up story was keep on going for the next 3 years. We did some acquisition at an early stage. Then we see a market to exit to investment immigration market as well, which is a pretty niche market. You know, for individuals, they acquire the properties and then they will get the immigration scheme. It was a buy and sell strategy, and if for buy and hold, you can easily find a deal for double digits of yielding, especially on tourism. So we have extended our investment to Greek islands as well. So they are pretty much very good, investment opportunity, giving the privatization of airports. Let's say the Germany company, they're pouring in the money to upgrade the airport, to bring more tourism to all these Greek islands. It was very different. Since 6 years ago, I was seeing Greece back in the years. Now they have upgraded all the airports. They have bring in many tourism, like travel company, thanks to the German company, because they are doing really a good job. The Chinese as well, because after they have invested the port in Athens, they bring in a lot more capital, and basically we are riding on this political status and also economic improvement of the country. Just last week, the Greece Prime Minister, they have visited China, and then the other way around, President Xi from China, he has also visited Greece this week, which means there are more and more foreign direct investments, especially from China, to put in money to this market, which is maybe this market we have overlooked from before as an institutional investors. So I'm glad to enter the market early, but I'm still seeing there's much more opportunity, giving that we see more foreign direct investment in place. Like Four Seasons, they have just reopened the branches in Athens. All this evidences points to a better market in Greece, especially in the Riviera area. Let's say the coastal area in Athens, that we focus a lot more on that.
So while London is mired in sort of uncertainty, Greece has the Chinese president coming to visit it and boosting investment into the area. Do we have any quick questions from the audience? We're almost out of time, but we can take a question or two. If not, I'll say to our panel here, if you have some advice for someone looking to invest in the UK or Europe, quick top investment suggestion, or if it's your own money, we'll say it's your own money, what are you going to invest in?
I think Prime London is still the strategy to possibly look at a place to start. But I think just because something has a discount, it doesn't mean there's a reason to buy. So it depends on buying it and what you're doing with it. And what I believe in is sort of just saying about that earlier is that the traditional long-let market in Prime London is being hurt, and there is an opportunity to reposition to a short-let type asset without doing a lot of work. So that's where I would put my own money.
If you just want to chase yield and buy and hold, buy a Zone 1 office building. If you are looking for generating an equity multiple return, I would look at a shorter duration, kind of 2-year sort of deal that is either in residential and playing to the affordable housing side. Yeah, that's pretty much it.
And Frank?
I still pick Greece. Get on the ride before it's too late, because the price was low. It's a difficult market, but get the knots untied, then we'll get there.
Fantastic. So Jack and Santa, our sales team here at One to One, your challenge is for the next event, we want a room full of Greece and Ireland and some prime central London real estate for everyone to come and have a look at. So can I have a big round of applause for our panelists? Thank you very much.